And welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax. Stewart, how are you during this busy holiday season?
Oh my goodness, it's just, I need a break. I need a vacation.
I know. You are so busy this time of year.
This end of year planning is just crazy. Listen, you know, when you get what you ask for, then, you know, don't start complaining, right? And we ask for people to start, you know, to keep doing their end of year planning. There's still time. Keep going. I'm willing to work as hard as it takes for, you know, people that want this end of year help. Super important. But no, but as you know, we've been blessed here. We're in a tremendously, you know, special place here. The Asset Preservation Hour has blessed us personally and our company with tremendous amounts of success. And you know, every year, you know, about this time, we like to remind people that it's really important to give back. And what we've done for, you know, a few years in a row here is we put out a challenge to our audience. And what that challenge is to just think about the blessings you have, the position you're in today, and know that there are families out there that are hungry, that are not going to be able to enjoy their time with their family because they don't have a hot meal. You know, at Asset Preservation for years here, we've been, you know, challenging the audience to donate to the St. Mary's Food Bank. And I think it's a really important thing that people get involved in. And what we're challenging you guys to do here today is to donate to St. Mary's Food Bank. If you click on our QR code that I'm going to put up there, or you go to apsitaxes.com, that'll take you to our website. And there will be a button on there that says donate to St. Mary's Food Bank. And what we're going to do as a company is that we will match dollar for dollar every dollar you donate to the St. Mary's Food Bank up to $20,000.
Wow.
So, you know, they know how to spread that money out, how to make it go a long ways. For every dollar you donate, that actually supplies 7 hot meals.
Wow.
So really important. As you're enjoying yourself, just know there's families out there in need. And as a company, we want to, you know, help do our part to help fight hunger. So if you do your part, we're going to meet you halfway there. Just take action and help us donate.
Stewart, nothing more important than giving back. So thank you so much for talking about the St. Mary's Food Bank today on the show. I mean, that is so amazing. And thank you for orchestrating that every year, because we've been doing this now for years.
Yeah, I mean, since the inception of our show, we've you know, we've been, you know, grateful for the, you know, outpouring of support as a company and that we get from our, you know, loyal audience here. But, you know, now it's time to give back, and we hope you extend that if you're able to as well. So
I love it.
Onward and upward here.
Onward we go.
Shake it off. I know it gets me a bit emotional. But
I know. I'm tearing up too. But we have such a big show. First of all, I want to talk about some things: the Secure Act, the tax implications of that, new IRS rulings with IRAs and RMDs, and how to plan your taxes. So first of all, Stuart, I'm going to jump right in. I want to ask you about the financial news. We're seeing a lot about the Secure Act. What is it? What does it do?
Yeah, so, you know, the Secure Act was, you know, actually passed a few years ago. And what the Secure Act did originally was, or what the intention of it was to delay required minimum distributions. And it did that. It got it moved from 70 to 70.5. I've talked about this in our previous shows, that I was actually part of a delegation of advisors that went to go lobby our both of our senators' offices and 2 or 3 of our local congresspeople. You know, I was able to set up meetings with the staff of Kirsten Sinema, of McSally at the time in 2019, Andy Biggs's office. We were able to speak to Dave Schweikert himself, as well as Debbie Lesko, to get them moving on this. And what we wanted to do was delay the required minimum distributions. Inadvertently, what was added on to it wasn't as beneficial as what we'd want, which is basically the elimination of what we call the stretch IRA. It's a big deal, because a lot of people historically have, you know, been able to defer their taxes inside IRAs and 401ks with the intention of being able to pass it to their kids over their kids' lifetime, so they could stretch it out 20 or 30 years over their lifetime. Well, what the Secure Act did was basically force your non-spouse beneficiaries to have to receive it within 10 years. Now, they wanted originally, Democrats originally wanted it to be 5 years, but they were able to renegotiate, get it to 10. But what that means is that you're going to be in this very compressed amount of time where your life savings is going to be forced out over 10 years to your kids. So a lot of people have to really rethink whether that tax deferral makes sense or whether they need to take action to plan around that.
Sure, that makes sense. Stewart, I want to ask you, the new IRS ruling that I've been hearing about, what is that?
Well, so the new IRS ruling regarding the Secure Act is very important. And what it is it basically, it was a little vague in the way the law was originally written, but the IRS just came out with some guidance recently that basically said that you still have to take required minimum distributions as a non-spouse beneficiary. So if you have what they call an inherited IRA, if I can spit it out, that you're now required to actually take RMDs. Now, before that, you were able to, the interpretation was that you would be able to take it out so long as it was gone within 10 years. They didn't care if you took RMDs or didn't take them, so long as it was gone within the 10th year, you'd be fine. But the IRS has come out and said, no, RMDs are essential or necessary for inherited IRAs. And if you don't do it, it could be substantial penalties, 50% penalties if you don't do it. So don't do that. Don't make the mistake. Make sure if you haven't taken your RMD yet on an inherited IRA, find out whether or not it applies to you. I'm not going to give you specific advice without meeting with you guys personally, but it's an important thing. If you inherited an IRA from one of your parents or just anybody that isn't a spouse, you may be required to take required minimum distributions.
Wow, and I have to ask you quickly, how does this apply to the Roth before we take a commercial break?
Yeah, so the one thing is it actually applies to the Roth, but there's no tax implications for the Roth. So even if you take distributions from your Roth, remember, it's tax-free. So the kids don't have to pay any tax when they inherit it. So the reason we always talk about Roth conversions, about having a tax plan, is because it makes it a lot easier for the next generations when it comes to tax planning.
Stewart, thank you so much. To our viewers at home, you may be wondering, what is a Roth? I'm going to ask Stewart that question when we return from this very short commercial break. Don't go anywhere. If you're wondering, what is a Roth? Stay tuned to our next segment. We'll be back.
People are really concerned about outliving their money. Inflation, taxes, volatility in the markets, legacy. That's what people are really concerned about. Listen, I love what I do. When a client of mine can know with total confidence that they're going to be okay. At Asset Preservation, that's exactly what we do. Not only do we look at your investments, we look at your taxes and estate planning as well. We don't leave any stone unturned. That is what a real holistic shop does. Provide a very clear roadmap so that you know it's okay to enjoy retirement. Success is being able to sleep at night. And at the end of the day, what we provide at Asset Preservation is not only the market expertise by institutional money managers that are some of the biggest and best in the world, but we also provide complete advice. You need to make sure you have a plan. What you can expect from us is to let you know the truth about your portfolio.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is the president of Asset Preservation Wealth and Tax. Stewart, a great show we're having today, obviously talking about the spirit of the holidays, the importance of giving back. And one thing we talked about before the commercial break was the Roth. So I wanted to ask you, just in case people in the viewing audience are wondering, what exactly is a Roth?
Well, what a Roth is, as opposed to its counterpart, it's a retirement vehicle that basically you've already paid taxes on. The benefit of it is that when you take it out, if it's been in there for 5 years, that all of the gains are all tax-free as well as the principal. So, people have been told their whole life that you need to put away money tax deferred and, defer it until when you're, retired and your income will be lower. Well, what we found out is that it doesn't always work that way, because just remember, right now, we are in this super tax efficient window, right? And when you pull money out of your IRAs and 401ks, you have to pay taxes. Well, that has implications on taxation for Social Security, your Medicare costs. There's all kinds of implications. And I'd also ask you the question, do you think taxes are going up or are they going down from where they are today?
Right.
You know, so you need to find out whether or not a Roth is right for you. Now, here's the thing, in almost all cases, especially if you're younger, a Roth almost always makes sense. Now, there's exceptions to that rule, and we always want to prove it through cash flow analysis. But, you know, the first thing to start, like if you're still working and contributing to an IRA or thrift savings plan or 401k, you want to find out if your employer has available a Roth 401k. And what the reason for that is that, you know, when people come to me and they say, hey, Stewart, we want to start a Roth with you, and I'll say, okay, well, tell me about your work and does it make sense? And you know, we look at their employer and they say, well, their employer has a 5% match. Well, guess what? I'm not using my funds to match your deposit.
Right.
Right. So a lot of times our advice is about just building your wealth at your existing company.
Yeah.
And then, you know what? We are looking for long-term relationships. We're not looking for an immediate, you know, client necessarily. What we're trying to do is make sure we're building really smart, tax-efficient wealth over time. And sometimes we can take advantage of that inside your thrift savings plans or your 401ks if they have that Roth component available.
So obviously I'm thinking at this from all angles right
Yeah.
now, Stewart. And if the Roth is such a better option, why aren't more advisors pushing clients in that direction?
Well, there's a couple reasons that more people aren't involved with Roth. Number one, they may not have an advisor, right? They've decided to go it on their own because the stock market's done so incredibly well for the last decade that a blind chicken could have made money. So they have this false sense that they're this amazing money manager because they've averaged 10% in the market, despite the market, you know, averaging way more than that for the last 12 years, right? So they're doing it themselves. But back to your specific question about, you know, why aren't more advisors suggesting it? Well, you know, I don't want to be conspiracy theorist here, but I really want you to kind of understand how, you know, people get paid in order to understand their motivations, right? Most financial advisors either make money through transactions if they're brokers, or if they're a true fiduciary, they make a percentage of the assets they manage. So let's just say for easy math that they make 1.5% on the money they manage. Well, if they're managing, you know, $100 million, well, they're making $1.5 million a year on your accounts, on the accounts they manage as a whole. But what if they decided one day that we're going to go ahead and convert all of these IRAs to Roth, right? And then they're going to pay a 24% tax on that. Well, guess what? The $100 million that they're managing could be reduced down to $76 million, and they just gave themselves a 24% pay cut, didn't they? So a lot of advisors have this kind of, you know, kind of duality of thought of, oh my gosh, you know, the market's down 25%. If I go and do all these Roth conversions, be down another 24%. Yeah, we're not going to do that. But remember also, most financial advisors realize that most people don't use their money if it's tax deferred. If it's in an IRA, people are afraid to use their money. They don't want to pay the tax bill. You know, I've talked about this story in multiple shows before about, you know, a few years ago, I had this great man. He was 83 years old, came in, he had about $3 million in an IRA. And, you know, when you look at it, you're like, wow, man, this guy's done a great job. And I even said it to him. I said, sir, you've done a phenomenal job of saving. You should be proud of yourself. And he looked at me and his eyes started tearing up and he said, Stewart, but what the heck for? I'm 83 years old. My wife is dead. I'm too damn old to enjoy the money. And I was so scared to take money out of this thing because I didn't want to pay a tax bill that I never got to take these trips that my wife wanted to take. I never got to do these things. So I have all this money and nothing to do with it. And I think that is the biggest trap.
Yeah.
The biggest trap is being stuck in a position where you now can no longer enjoy your life's work. And if your whole goal in life is to amass this money to show it off to your friends, well, guess what? You're the wrong people for our firm. We're not interested in working with you anyways. But if what you're trying to do is figure out a plan of how we can create the most tax efficient, an enjoyable retirement that you can think of, one where you can do things without limitations when it comes to tax, and creating a real tax plan really makes sense. If you think that makes sense, well, then we may be the right firm for you, but we're not right for everybody. I just tell you one thing. Don't be trapped inside all these tax deferred investments, because I'm telling you, you're going to have to pay the piper one day.
Stewart, thank you so much. And obviously, talking about taxes, I know you're so passionate about it, but I have to ask you, why do a lot of other advisors shy away from talking about taxes with their clients?
Yeah, I mean, the truth is, there's a couple answers. Number one is most of them are prohibited. So if you're dealing with a financial advisor, at one of the banks or one of the big box firms, most of them prohibit their advisors from giving any sort of tax advice whatsoever. I mean, we see it all the time where a client will come to me and they'll say, hey, you know what, we were watching your show, and so we went back to our advisor and said, hey, this loudmouth on TV kept talking about Roth. We thought it was a good idea. But then the financial advisor said, okay, well, if you think it's a good idea, go talk to your accountant and let us know how much you want to convert. Well, then your accountant says, go talk to your financial advisor. So the right hand never knows what the left hand's doing. And so these advisors that don't give tax advice or don't have a built-in tax office, quite honestly, it puts them in a really bad spot, right?
Sure.
So A, they're prohibited. B, they don't know. They don't know whether it benefits you or not, because they don't do a real cash flow analysis in-house. Most advisors don't have a built-in tax office to determine whether it's the right thing or not, which is why we have a tax office at our firm. So if you're dealing with an advisor, make sure you demand that they have a tax office or they do tax planning, or sometimes it's just ready to, time to find a new advisor.
Sure. And sir, I know people in the audience right now are wondering what they can do to help with their own taxes. Do you have a special offer to present to those people?
Yeah, absolutely. What we're offering the audience today is a complimentary portfolio review. So if you pick up your phone now, you take a picture of that QR code in the bottom right screen there, what that'll do is that'll take you to apsitaxes.com. That's our website where you can click on the complimentary portfolio review. Or if you give us a call at 833-652-7829, that complimentary portfolio review will include an assessment of whether or not a Roth makes sense for you. What we'll do is we'll let you know, are there any tax benefits to deferring taxes continually, or does it make sense to diffuse that tax time bomb? We'll also take a look at what kind of risk you're taking. What kind of fees are you paying? Or do you have some sort of annuities in your portfolio that are just costing way too much? Give us a call. We'd be glad to give you a second opinion. 833-652-7829. But take action today. We'd be glad to help.
Stewart, thank you so much. To our viewers at home, that number is on your screen. It's 833-652-7829. We know you have a lot of questions for Stewart about how to plan your perfect retirement and about taxes. He has the answers for you. Speaking of retirement, I'm going to talk to Stewart about how the face of retirement has changed through the years, specifically pensions. So stay tuned for this next segment all about pensions. We'll be right back momentarily.
Right now, the market is a big mess, and oftentimes people feel lost. So while most people are scared, you need to know that you're going to be okay. I'm sure you have a lot of concerns about whether your portfolio really fits you. And if you need help, all you have to do is give us a call. At Asset Preservation, what we offer is a complimentary portfolio review. We can provide that fresh set of eyes to give you that second opinion. You can't get a second opinion from the guy who gave you the first. You want to make sure you're dealing with a fiduciary. We'll give you that fiduciary perspective. If you have a relationship with a financial advisor that you don't entirely enjoy, I think that's a problem, because these relationships are not meant to be short term. They're meant to last a lifetime. You don't want to deal with people you don't like. If you have concerns about your portfolio, you need to give us a call.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax. Stewart, obviously, I'd love to talk to you in this segment about how the face of retirement has changed through the years, specifically pensions. Everyone seemed to have a pension when they retired. Are they going away? Are they becoming a dinosaur?
Yeah, I mean, I think they really are going the way of the dodo bird. They're kind of just disappearing now. Now, The nice thing is here in Arizona, we have, a few companies that still have some really great pensions with great options. Honeywell, for example, and oftentimes what we're seeing is people are listening to their friends and saying, hey, should I take it over a single life pay for my spouse? Do I take the lump sum? And here's the thing, everybody's situation's different. And in fact, your pension options could be different. You look at Honeywell, for example, if you were from the original Allied, signal company, your options could be dramatically different than somebody else, right? Like one of our clients that was at Honeywell, actually, the more she delayed her pension, meaning if she took it later, it continued to grow at a really high rate of return. So just like Social Security, you get like delayed retirement credits, and it worked the same way. But there's other pensions inside Honeywell that it didn't make sense to delay, right? It didn't make sense to continue to defer, because whether you took it at 60 or 65, you were getting the same amount of benefit. So everybody's situation's different. You want to make sure that you know in your specific situation if it makes sense to take it, early, take it later. Because remember, Cynthia, a big part of the planning that we do when it comes to pension plans also includes Social Security. Because look, I could come up with the greatest plan ever to maximize your benefits from pensions or Social Security, but if you have to eat dog food in order to accomplish that plan for the first 5 years, I didn't really do my job, did I? Right. So I think it's really important to make sure that that the plan fits you, it fits your lifestyle, but you have to consider the implications. So let's just use a hypothetical example of someone that's allowed to defer their pension for 5 years because it continues to grow. Well, that may actually buy us time to do some really efficient tax planning. It all depends. That's why we need to cash flow out to determine whether or not it makes sense for you, because everybody's situation is different. The other thing, does it make sense to do a lump sum? Yeah. Maybe, maybe not, right? I mean, sometimes I see these projections where the pension plan is paying out such an exorbitant rate that there's no way that rolling it out makes sense. But in some cases, it does, because what it allows you to do, if you have a goal of passing assets to like a non-spouse beneficiary or to your kids or to whoever, well, maybe it makes sense to do a lump sum. You roll it out to an IRA, and then you start doing those Roth conversions, right? Back to the Roth conversion. I keep talking about it over and over again. But maybe it makes sense because you want your life's work to be able to carry on for other people as well. Like, what if you don't have a spouse and you want your kids to benefit, or you want your girlfriend or your life partner to benefit from your life's work? Well, oftentimes these plans don't accommodate for the girlfriend or the life partner or whatever your situation is, or your kids, right? So you need to make sure you just have a plan and analyze whether it's right or wrong for you.
Well, Stewart, you're so passionate with helping your clients to thrive in their retirement, but I have to ask you, who is the right client for you?
You know what? The right client for me is somebody who knows that they've done their job. Someone that is trying their darndest to put money away. They've done it for years, but they just need help, right? They're looking for help. And I'm telling you, at our company, we are willing to give that help. We're willing to give you that complimentary portfolio review. By doing the complimentary portfolio review, you're not saying to us that you want us to be your advisors. And we're not telling you we want you as a client. It's kind of like a first date to determine whether or not we're even a right fit. Right? I think it matters to be helpful to people. And sometimes it's not a good fit right now. Oftentimes we have clients that'll come in and say, hey, you know what? Love your TV show. But what we're doing right now is testing whether or not you're the right fit, not for me, but for my spouse, because sometimes people are self-managed. They manage their own assets and they will not take help from anybody, but they realize that once they're gone, that their spouse is completely lost. And sometimes it's worth laying the groundwork to have a plan, a contingency plan, so that if something happens to you, that that your spouse who survives you will have someone to go to, or your kids will have someone to go to. Because what we always tell our clients is that if you become a client at our firm, we're committing that we'll be there for your surviving spouse. And if you're not a client, and right now is not a time, Well, guess what? There's no better time than now to determine whether or not you're comfortable. Because if you want to be part of that decision to determine whether or not, some firm is right for your surviving spouse or your kids, then you should be the one doing the interviewing while you're alive and healthy and able to make those decisions, right? But you've got to seek help and start that process now. I think it's a really important thing. The other thing, I want to go back to this. Remember, it's a season of giving, right? You guys know that, we've done this year after year. We want to raise money for the St. Mary's Food Bank. For every dollar you donate to the St. Mary's Food Bank, we will match you dollar for dollar up to $20,000 this year. And for every dollar you donate, that feeds 7 people, 7 meals for $1, right? Now you can get there if you go to our website at apsitaxes.com, or even easier, pick up your phone, click on that QR code right there, and click on a St. Mary's Food Bank donation, and we will match you dollar for dollar every single dollar up to $20,000, because it's time to help, and this is the season of giving.
Well, Stewart, with about a minute and a half left of the show this week, just in case someone is wondering, what can they expect from you if they become one of your clients before we say goodbye?
Well, if they become one of our clients, the one thing we do is we promise you a warm place to go, someone that, you want to find out that it's someone you enjoy talking with, because if you're in a position where you have a financial advisor, you don't really like them, guess what? The likelihood of you calling them for advice gets lower and lower. So what we promise you is a happy smile, a warm place that welcomes you. And what we'll do is give you the best that we have. Then we will not let any stone be unturned. We'll look at your taxes, your investments, your fees. We'll take a look at everything.
Stewart, thank you for another amazing episode this week. To our viewers at home, most specifically, we want to thank you for spending time with us. That number to call is 833-652-7829. We know that you have a lot of questions for Stewart about how to plan your perfect retirement, how to plan for your taxes. He has the answers for you. Again, all you have to do is call the number 833-652-7829. If you have your smartphone, go ahead, grab it, click on the QR code in the bottom corner of your screen. That will take you right to Stewart's landing page. Again, thank you for watching the Asset Preservation Hour. Be safe, be happy, and be blessed this holiday season. We look forward to seeing you back soon. Take care now.